Tesla presents an extreme paradox in modern finance. It operates an industrial automotive manufacturing business, yet the market prices it as a high-margin software monopoly. To put a number on that discrepancy, the company's forward price-to-earnings multiple currently floats between 111 and 168. Investors are paying up to $168 for every single dollar of expected future earnings. This chart illustrates the core of the problem. On the left, the blue line tracks that soaring software-level valuation. On the right, the red line tracks actual operating margin. Since 2022, operating margins collapsed from 17% down to a floor of just 4.2%. This widening gap between mathematical reality and market sentiment has prompted institutional analysts to issue specific sell and caution ratings. Their models plot a steep downside, establishing a valuation floor between $145 and $175 per share, less than half its recent trading level above $400. The Henry Fund summarizes this disconnect precisely. The stock dreams in AI, but the cash smells like rubber. These bearish targets depend on the specific performance of each business segment, starting with the cars rolling off the assembly line today. The current market price assumes a flawless, multi-trillion-dollar execution of a physical AI future. If the manufacturing core stumbles, there is no margin of safety left for investors. The foundation of Tesla's actual cash flow remains its electric vehicle manufacturing business. Going into 2025, analysts project a 6% contraction in total vehicle deliveries. This bar chart tracks U.S. EV sales for Q1 2025. Tesla's red bar sits at 127,000 units, but the green composite bar shows competitors have now surpassed them at 155,000. This is a severe contraction. Legacy brands have carved Tesla's former 80% market share down to 43.5%. But the domestic U.S. market is only a fraction of the global picture. The most critical battleground for EV volume and the cost leadership that comes with it is in China. In the world's largest electric vehicle market, local manufacturers are aggressively outscaling foreign competition. BYD currently holds over 35% of the Chinese EV market. Tesla holds approximately 9%. BYD's success is driven by its ability to vertically integrate battery production, microchip manufacturing, and assembly under one roof. This allows them to maintain profitability at price points Tesla simply cannot match. Lacking a comparable low-cost model, Tesla's primary defensive strategy has been aggressive continuous price cuts across its existing lineup. They are effectively purchasing delivery volume at the expense of profitability. This staircase chart maps the financial impact of that strategy. As the average selling price drops on each chronological step to maintain market share, the corresponding red area representing operating margin shrinks beneath it, compressing down to those industrial lows. This margin squeeze is compounded by operational bottlenecks. The recent revamp of the Model Y required multi-week production line shutdowns across multiple global gigafactories, introducing idle capacity costs and further eroding profitability. Looking forward, the company faces a severe macroeconomic headwind, the proposed elimination of the $7,500 federal EV tax credit. If enacted, Tesla must either absorb a 10 to 15% price hike, crushing margins even further, or pass the cost to consumers and risk a collapse in demand. The data points to a clear conclusion. Caught in a capital-intensive hardware cycle with compressing margins, Tesla is operating as an industrial manufacturer, not an insulated software platform. The external pressures from competitors and regulators are heavy, but institutional analysts are equally concerned with internal corporate headwinds, specifically an earnings drag driven by aggressive corporate governance. This begins with the board's approval of a $29 billion share-based compensation package. When shareholder equity is fractured into millions of new shares to pay executives, it directly dilutes existing investors, creating an estimated 3% annual drag on earnings per share. Beyond dilution, analysts point to a severe qualitative risk factor: executive distraction. The CEO's polarized political involvement, including a 130-day special government employee role and the announcement of a new political party, pulls critical focus away from the core engineering mission at a time when the company needs to execute flawlessly. This political entanglement has direct financial consequences. A public feud over proposed legislation to eliminate EV tax credits triggered a massive sell-off, wiping out $150 billion in market capitalization in a single day. There is one tangible bright spot within Tesla's operations: the rapidly expanding energy generation and storage segment. Driven by the successful deployment of large-scale megapack batteries, the energy unit achieved an impressive 67% year-over-year revenue growth. Yet, despite this exceptional growth, energy storage only accounts for roughly 16% of total revenue. It is mathematically impossible for battery deployments to single-handedly rescue a trillion-dollar valuation that is being actively dragged down by automotive margin erosion. Recognizing the limitations of the commoditizing automotive business, management has explicitly pivoted their strategy. They are shifting away from vehicle-centric growth and betting the company's future on an FSD-centric physical AI model. This pivot carries an immense financial burden. To justify the current stock price, the company requires a seven-fold increase in overall revenue. The auto segment alone cannot deliver that. This revenue decomposition matrix shows automotive revenue dropping to just 43% of the business by 2034. To fill the gap, unproven products like the Optimus robot and Cybercab must capture over 30% of total revenue, requiring aggressive double-digit growth year over year. The transition to this high-margin revenue model depends on a single milestone: achieving unsupervised Level 4 or Level 5 autonomy by late 2026. Tesla is attempting to solve this using a vision-only approach, relying entirely on cameras. This stands in stark contrast to competitors like Waymo, which utilize a robust, hardware-heavy architecture involving LiDAR, radar, and strict geographic fencing to ensure safety. Relying solely on cameras introduces a massive binary regulatory threat to the entire valuation. The National Highway Traffic Safety Administration is actively investigating the company's software following fatal incidents. If the vision-only architecture cannot safely solve rare, unpredictable edge case scenarios, the company faces the existential risk of forced recalls. Because the stock's massive premium is entirely underpinned by the promise of physical AI, a single regulatory block or a high-profile multi-fatality software glitch could instantly vaporize the company's growth narrative. This brings us back to the central financial reality. Right now, Tesla is an industrial manufacturer trading exclusively on the promise that it will become a future software monopoly. The critical question driving the institutional sell ratings is this: what happens to the stock if full self-driving stalls, Optimus fails to scale, and the market is forced to value the company as a traditional hardware maker? The result is a process known as a valuation reset. If the market abruptly strips away the speculative AI premium, the current 168 price-to-earnings multiple would rapidly collapse, locking in closer to a 25x multiple, the standard rate for a premium auto manufacturer. Applying this premium auto multiple to a 4% operating margin creates a catastrophic equation for shareholders. Analysts calculate this reset would drive the share price past initial targets, settling at a $38.50 floor, a 90% wipeout of market capitalization. To invalidate this bear case and justify its current premium, the company must hit strict, non-negotiable milestones. It must deliver genuine Level 4 unsupervised autonomy, prove the unit economics of the Optimus robot, and recover its automotive margins through a high-volume, lower-cost Model 2. Until the dream of physical AI translates into tangible, high-margin cash flow, the financial risks inherent in the core business vastly outweigh the speculative rewards.